Welcome everyone to Vested Interest. This is Shane back for the last stock pick of the day video for April. We are going to take a look at one out of the consumer discretionary sector, Starbucks coffee. I'm sure everyone is well aware of this company, this retailer here. If you could do me a big favor before we get too far in the video, it doesn't cost you but a couple seconds of your time, and it really does help out a small YouTube channel like mine with the YouTube algorithm. Hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever I put out any new content. I do this stock pick of the day video series Monday through Thursday when the market's open. We take a look at a company stock that's pulled back on the day, run it through my screener, see how it stacks up, and if it makes it onto my watch list or not. And if it does make it onto my watch list, that does not necessarily mean I am buying. That just means I'm interested in doing more of a deep dive into the financials of the company. It is an initial screener only, not a deciding factor on whether or not I'm investing. There is the thanks button down below for anyone who might want to buy me a cup of tea. And let's get back to it. This is the Vested Interest Stock Screener. You can pause this, go through this criteria. It must meet 5 of 8 to make it onto my watch list. If it was a company out of the financial sector like a bank, we throw in price to book with 1 as fair value. Do not blindly use 1 as fair value for every company. It doesn't work for companies outside of banks and insurance companies, and even some of the other companies in the financial sector like credit card companies. It doesn't necessarily work for those either, but really for banks, 1 is fair value, and some insurance companies. So that's why I like to use it. You can use price to book for any company. Just compare it to itself over time. You can see it over years for itself and with companies that are comparable to it in the same sector, maybe selling some of the same type of items. If it was a consumer staple or consumer discretionary, if it's something like industrial, maybe out of the let's say a railroad, for example, Union Pacific, you could compare to other railroads. If it's something out of the defense sector like Lockheed Martin, you could compare it to other defense companies, so on and so forth. All right, now that that's a little long-winded, I just downloaded a couple of the things from their menu, right? I'm sure everyone is aware of Starbucks. Starbucks is a big retailer. They offer primarily, drinks, coffees, and teas, but they do offer some lunch items, breakfast items, snack items. I know my kids like these little cake balls that they like to get. That's not actually a sucker, it's a cake ball. Bakery items, lunch items, cold teas, frappuccinos, hot chocolates, iced energy. I actually like their hot chocolates. They're not bad. I don't get much of anything there, but my wife and my daughters do like it. Hot coffee, hot tea. I don't drink coffee, but I do drink some tea. I prefer green tea myself, but that's another story. But I'm sure we're all well aware of it. You've probably driven by one, maybe stopped in one, maybe go there every morning to get your coffee. They are pretty pricey, I will say, but I know they are very popular. And the reason we are taking a look at Starbucks Corporation, down 5.66% on the day. Big drop on the day, and they did recently have earnings. They actually, I believe, went up after earnings, so I was a little surprised by that, but maybe they were just waiting for a couple days later. We are talking about Starbucks Corporation, ticker SBUX, out of the consumer discretionary sector. Closed out the day at $80.05. Looks like whenever I pulled this information a little after 4 o'clock, it was down a little bit more in the after hours. 52-week range as low as $71.55, as high as $117.46. They are within 15% of a 52-week low currently. 82 cents and some, or $82 and some change there puts them within 52-week low, so they're below that. Market cap of $90.931 billion. Abeta, they didn't have that listed. I did not look at it. I believe they are less volatile than the overall market most of the time. They may be more volatile right now with the ups and downs because of earnings, and sometimes that happens where you'll get that not listed. But you could look at another source like stockanalysis.com or any other source that lists Beta, which is the volatility of the market, and probably pull that from somewhere else. PE ratio is sitting at $25.82 per share. Price to earnings there seems a little high for a company like this. This is pretty well built out. I know they're still opening stores, but I mean, they're all over the world at this point, still expanding in some countries. I know like China, but they're facing some issues in some competition. I think they're still building out in countries like India and a couple others, but pretty well. I mean, I've been all over the world myself. Mexico last year, we went to the Dominican Republic. This year, we pretty much go somewhere every year, and everywhere we've gone, we see them. So earnings per share, EPS sitting at $3.10 per share. Earnings date coming up July 28th, or the next one anyway. Again, they just had a earlier this week, their earnings call. I believe it was this week or last week. They're all blending together now, but earnings call season right now, I believe it was this week, a couple days ago. Earnings, next one is July 28th through August 1st. Forward dividend is $2.44 per share. They are a quarterly payer. We'll see that here in a minute. Dividend yield starting at 2.88% currently. Ex-dividend date, May 16th. They are going to pay out on the 30th. So you want to buy them on May 15th or before to get the next dividend payout, right? Don't buy them on the 16th, not on the ex-dividend date, the day before, or even, tomorrow if you're interested. 1 year target estimate according to Yahoo Finance, $93.32. So they do see it going back up from here, but not quite back to its 52-week high. Now, forward or dividend yield theory is one I like to look at to see if the company is potentially undervalued. It's just a quick reference. It is not the end-all, be-all. 5-year dividend yield average is what you look at first, 2.08%. You compare that to the current, right, where it's, it says forward, but it's the current 2.88, or over here where it says forward, same number, 2.88. And since it is higher than their 5-year average, that speaks to undervaluation, at least according to dividend yield theory. Now, their payout ratio is getting up there, and actually there's a bit of a discrepancy here. Yahoo Finance has it at 74.84, which is right at that 75 number or less I'm looking for. And then stockanalysis.com, which is the other source I go to, has them in the 80 range. Now, I've seen them hovering in the high 70s to low 80s here over the last several weeks. So I'm not sure if this is up to date or if it's a little outdated, but I am not going to give them a payout ratio under 74 unless I can find a third source there that shows them under 80. I'm leaning more towards stockanalysis.com's report out at 80% or 88%. And even if I added the two together and divided them to get an average, that would be above the 75% I'm looking for. Now, dropping down, I want growing free cash flow over time because companies can do some things with that free cash flow. They can buy back shares, they can pay a dividend, which this company does, they can reinvest back into the company, which this company does as well. That's how they open up new stores. They can use some of that money to invest, whether that's buying up another company, buying someone out if they had a competitor, for example. I think Dutch Boys is one that's really kind of growing right now that's a competitor to this one. So they can do some things with that free cash flow. Among them is raising the dividend, which we want them to do. Well, maybe not if their dividend payout ratio is this high, but typically as a dividend growth investor, I want growing dividends. So they can use that free cash flow for that, buy back shares as well. Going back to December 2021, you can see here $2.5 billion in free cash flow. 2022 is up to 3.6. Nice jump up there in 2022. 2023 looks like down to 3.3, and 2024 down to 2.9. Now, I will say they are repurchasing shares. In 2021, $4 billion pulled out of the market there. 2022, you might have to do the math here. They dropped their repurchase of shares by over $3 billion, and their free cash flow went up. Is that because they didn't repurchase as many shares? Might be. Same thing, they went slightly back up here to 1.2 billion in 2023, but I don't know if that accounts for the 300 million decrease in free cash flow. And so far, or in 2024, they didn't buy back any shares. So you definitely are seeing a downturn there in 2023 to 2024. Now, jumping over to stockanalysis.com, this is another source I go to for information. Again, not affiliated, just one of the sources I go to. I do recommend 2, if not 3 sources, so you can make sure the information you are getting is accurate and up to date. I only look at 2 on this video, so I can keep it relatively short. I'm trying to keep them, 15 minutes or under, so that you can get some information and kind of see some of these companies out there run through relatively quickly. That's part of the reason I only look at 2. But I do look at other sources beyond these 2, and I recommend you do the same. And make sure that you get the information is accurate and up to date is really what I'm looking at. Sometimes there's discrepancy, like the payout ratio on this one. So this is where I'd look for a third source. They have 24 analysts that have taken a look at this. They do call it a consensus buy, though it is right on the edge of a hold. If you were to go to stockanalysis.com, you could click on each one of these tabs and see how many might call it a strong sell, a hold, a buy, or a strong buy. But of the 24, the majority are calling it a buy. Or maybe some calling it a strong buy. That might skew that a little bit. You might have some, I didn't look, but you might have some calling it a sell or a hold, with some calling it a strong buy that gets it into that buy range. That's why you'd want to go and check it out for yourself. Low estimate of $76 would represent a 5.01% decrease from where it currently sits. Average estimate of $97.75 would represent a 22.17% increase. Pretty close to what we saw with Yahoo Finance on the previous page, a little bit higher. And then if it hits their high of $120 estimate, that would represent a 49.98% increase. Jumping over to the right, you'll find it under Statistics tab. I like to look at return on capital employed. I want 10% or better here, sitting at 20.77%. So well above the 10% I'm looking for there. EPS growth, same thing. I like 5% or better forecasted over the next 5 years. 14.35, very good number overall. 8.44 revenue growth forecast. This one I look at more when I do a deep dive into the financials, but I throw it in here anyway. All right, quarterly pay, as we mentioned again, payout ratio, stockanalysis.com says 88%. I've seen this elsewhere in the 80% range, so I'm going to go with that. Dividend, someone correct me if I'm wrong. If you've seen it a couple places under 75%, then maybe I'm wrong, but I've seen it in a couple different places in the 80% range. Not quite 88. I think another source I saw it at 82 or 83, somewhere in there. And then even Yahoo Finance had it at 78%. So either way, it is getting, or 74 point something percent. So either way, it's getting up there above the 75% that I'm looking for. Dividend growth at 7.14%. 10 years of dividend growth. Buyback yield is positive, so this means they're pulling shares out of the market efficiently, pulling more shares out than they are putting in. Shareholder yield is positive at 3.58%. They do pay out on the off schedule than most companies, February, May, August, November. I like that. And going back here to November 2022, they were paying 53 cents. They raised it up in November 2023 to 57 cents, raised it up again November 2024 to 61 cents. And if they're going to maintain this dividend growth, I would anticipate a raise November of 2025. But I'll be honest, since they are kind of in the turnaround phase, I would not be surprised if they might pause the dividend, especially if we go into rough times, economic downturn. People aren't going to be buying coffee and tea if they, have to focus on putting gas in to get to work instead of coffee and tea. They'll go that route. So you could see this paused, if not cut, if it really is in the 80% range. All right, let's look at the screener. Now, there's a lot of green in the screener. Understand the business. Again, they're a retailer that specializes in selling, coffees, teas, some food items as well. And they have some different ways, like I've gotten my wife their little cards where you put cash on them give them $100 and they give you $100 worth of payments on like a credit card, almost like a Starbucks card that you can only use there. So they have that as well. I know they have some money sitting out there in a bunch of cards. I always wonder if they're ever going to get all of that back. I know they count it as part of their, or don't really count it as part of their revenue, but they anticipate they'll get it back. But I know my mom is getting a little older. She's in her late 60s, almost in her 70s. And she's starting to forget things. And some of those things are, where she puts cards, not just her credit cards, but other cards. So I'm anticipating or wondering how much of that they will actually lose, even though they got it. And I guess if it's preloaded, do they count that whenever it's preloaded? Is that whenever they actually get the money, or do they actually get the money whenever it's spent? I guess I don't know that for a fact. Let me know in the comment section. Do they count the revenue whenever you buy the card, the preloaded card? Or do they get it whenever someone actually buys a product from them? I'd love to know that. I have not done a deep dive into figuring that out. Growing dividend, yes. Dividend, sorry, got a little long-winded and off track there. Growing dividend, yes. Dividend payout ratio under 75%. I'm going to say no. Check valuation based on dividend yield theory. Dividend yield theory says it's potentially undervalued. It is within 15% of a 52-week low. Return on capital employed is over 10%, over 20% actually. Earnings per share growth is over 5%, so check there. So we're looking at 6 of 8. This one, if I'm being completely honest, it is on my watch list. I have bought this before. I was buying it in the mid 70s and I sold it in the high 90s because I thought it was overvalued at the time. I mean, the only reason it jumped back up was because they changed CEOs, and I just don't think one person is changing anything until the fundamentals change. It's still the same business, so that's what I'm looking at. I'm looking at the fundamentals. I may, even if this got down into the low 70s, might look to add it back in, but I would probably, unless things changed and it jumped back up into the high 90s or 100 or something, I would probably sell it again for the 20-25% gain that I got on the last time I did it. So that's how I feel about this one. Let me know what you think down in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. I do personally join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. If you have a company like Starbucks you'd like me to cover in the Stock Pick of the Day series, drop it down in the comment section. I'll try to work it in on the day it pulls back. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week and weekend, and we'll see you in the next one. Hey, I'm not a financial advisor, definitely not your financial advisor. Make sure you're doing your own research. And if you've made it this far, don't forget to like, share with anyone you think that might find value. Drop a comment, hit the subscribe button, and click that notification bell.